Today, I'm sharing something you must know ahead of the coming earnings season. If you don't heed this warning, it could cost you dearly. Now, here's the deal. As usual, this time of year brings a flood of Wall Street analyst activity. We're talking about buy recommendations, upgrades, and raised price targets. All of it presented like it's the gospel truth. But sadly, here's the problem. Analysts issue buy recommendations roughly 55% of the time, and sell recommendations only 5% of the time. Yeah, 11 times more buys than sells. That's truly insane and truly useless to investors. Clearly, we all need some way to separate the truly exceptional buy opportunities from those that simply get a rubber stamp recommendation. That's why today I'm going to give you a brief education on how to tell the difference so you can invest more wisely in the months and years ahead. I'm going to show you two stocks that look identical on the surface, near unanimous buy coverage from Wall Street on both. But when you dig beneath the surface, they tell very different stories. One of the stocks looks generally strong, the other is flashing serious warning signs. Now, be sure to stick around to see my breakdown of both because it could help you avoid this unsavory consequence of buying solely based upon Wall Street recommendations in the future. By the way, I'm Steve Reitmeister. I've been investing for over 40 years. I spent nearly half that time as editor-in-chief of Zacks.com. Now I'm a partner at WallStreetZen.com, where I help create a quant rating system to simplify the fundamental research for stocks, which gives investors greater peace of mind. If you like timely stock insights like this, then please hit that like button. That's my signal to record more videos like this in the future. Now, first, a quick explanation of why Wall Street issues 11 times more buy recommendations, because it's not an accident. Sell-side analysts work for banks that want business from the very companies they cover. At the same time, they also need ongoing access to company management. So, from the analyst's point of view, publishing a sell recommendation puts both of these things at risk. Over time, these incentives have quietly pushed the whole industry towards buy recommendations. It's not a conspiracy, but it's perhaps a conflict of interest. In this environment, a hold is perceived as criticism, and therefore a sell is an outright act of aggression against the company. The result, the buy recommendation has been stretched so thin it barely functions as a meaningful filter anymore. Think about when you were back in school. Think about the student sitting next to you that highlighted nearly every word on the page. There was no benefit because if you highlight everything, then nothing is truly highlighted. To be fair, I'm not saying there's no value in Wall Street insights. These analysts are well dialed into industry conditions and individual company strengths and weaknesses. The problem is the profit motive of these firms have made their buy recommendations nearly useless. So when earnings seasons comes around, as it is now, and the upgrades start flying, then you need a second source of information you can truly rely upon to make better investment decisions. That is what we're about to cover. So please remember, this is for educational purposes only. Any investment decisions are yours and yours alone. So always do due diligence before buying or selling any stocks. And by the way, this is precisely the type of timely insight I share in my live weekly training sessions. These sessions are totally free and include my most up-to-date stock market outlook and top stock picks. Please join my next session this coming Monday at 7 p.m. Eastern Time. It's totally free. Just register now by scanning the QR code on your screen or click the link in the description now. So let's start with a stock that looks great on paper. We're talking about Snowflake with a symbol SNOW. This is a cloud platform company that works with data warehousing, analytics, and AI workloads. It's an impressive company that has grown to $90 billion market cap. Now, the narrative is that Snowflake is now core infrastructure for the AI era. Now let's check out the Wall Street recommendations. We got 22 strong buys, 8 buys, 3 holds, and of course, no sell recommendations. So that means 91% of covering analysts are bullish on these shares. Now, if buy recommendations occur 55% of the time across the entire market, and that skews more generous than it should, then 91% bullish is truly an extreme version. If that's all you looked at, then Snowflake would appear to be an absolute slam dunk. But here's what happens when you dig a little deeper. As of the most recent earnings report, Snowflake was still losing money. And looking back the past 12 months, that loss has been a whopping $1.2 billion. So the current picture does call into question that $90 billion market cap, right? So now, let's run Snowflake through the Zen Ratings quant model. The system puts every stock through a rigorous 115-factor review and then distills it down into a simple, easy-to-read letter grade of A to F. The A-rated stocks have historically nearly tripled the gains of the market average, whereas the Fs typically lose money, which rightfully points to stocks that should be avoided. Right now, Snow earns a C grade, which amounts to a very middle-of-pack hold recommendation. Note in our case, only 20% of stocks are buy rated, 20% of the stocks are sell rated, and 60% are in the middle C rated holds. Hold's not bad, but it's not good either, as it points to a stock with a low likelihood of outperformance. Each overall rating can be further broken down into 7 component grades that helps highlight a stock's unique areas of strength and weakness. Now, notably, Snowflake earns a D for value, ranking the bottom 20% of stocks tracked for this vital metric, meaning the stock is running more on hype than true fundamentals, which often doesn't hold up over time. It also earns several middling C grades for financial strength, momentum, safety, and sentiment. Like with the overall grades, C's are not necessarily bad, but it's certainly not a reason to run out and buy the stock either. And I should mention that these Zen ratings are updated daily. So to get the latest data on this stock or any other, be sure to visit the quote pages on WallStreetZen.com. Now, back to Snowflake. The line that sums it up is right here on the Wall Street Zen forecast page. Although Snowflake's forecast from analysts indicates a strong buy, our proven Zen ratings show Snow as a hold. With Snowflake, you see big enthusiasm from the analyst community, but you see a very different story when you check the real numbers through the lens of a proven Zen ratings quant model. That's the investment trap you need to avoid. Now, let me show you what it looks like when analysts actually get it right. And a quick heads up, if you want more stock commentary like this, then the best thing you can do right now is sign up for my next live training session this coming Monday. The focus is on timely market insights plus my top stock picks. It's totally free, but you do need to sign up. Do that now to join me this coming Monday at 7 p.m. Eastern Time. Just go to wallstreetzen.com/live or use the QR code on the screen. Now, let's consider the flip side. When Wall Street buy recommendations is as good as advertised, we're going to do that with Micron technology, the symbol of MU. Now, Micron, as you well know, makes the memory chips that power everything from laptops to AI data centers. And it is the very latter part about soaring AI demand that has made Micron one of the most exciting growth stocks in recent memory. Yeah, the pun was intended. Okay, Wall Street analysts have been incredibly one-sided on Micron with rousing bullish approval. 18 strong buys, 7 buys, 2 holds, and once again, no sells. The net result is a stock that is up over 800% in the past year alone. And yes, there is good reason to believe there's more upside to come, and we'll get more to that in a minute. On the surface, this looks pretty similar to the Snowflake situation we just walked through. But here's the difference. When you dig deeper with Micron, the fundamentals actually back up the excitement. For example, their most recent earnings report showed a 4x increase in revenue, leading to a 13x increase in earnings. Let me say that again. 4x increase in revenue, 13x increase in earnings. That is truly mind-blowing earnings momentum. Even better is that management said demand is still running so high they needed to massively increase estimates for the quarter ahead. This got analysts busy with a new round of much higher price targets. Now, another big difference with Snowflake is what happens when you run Micron through the Zen ratings analysis. Here they earn an elite A rating, which typically points to future share price outperformance. The component grades are exceptional as well, with growth, momentum, financial strength, and sentiment all grading out as A. This means they're in the top 5% of these vital categories. Note that growth and financials are the 2 most beneficial to find stocks that keep pounding out more earnings beats, which generally leads to share price increases. That's the alignment you're looking for. When analysts and the underlying fundamental data from the Zen ratings are pointing in the same direction, that is when you have a recommendation that's worth more serious weight. Now, I'll be real though. With Micron, there is one flag worth knowing about. Safety only grades out as a D, which is in the bottom 20% of all stocks. But let's be honest with ourselves. Semiconductors always provide a more volatile ride. And this is what the safety grade is reflecting. The good news about volatility is that it cuts both ways, meaning it often points to stocks that can truly rocket higher as well. Okay, let's put it all together. Analyst buy recommendations are an interesting start to an investment conversation, but the Zen ratings helps you know the bottom line. The more A-rated stocks you have in your portfolio, the more fundamentally sound the companies are that you're owning, the more likely you are to outperform the market. The best news of all is that Wall Street Zen is the exclusive home to the Zen ratings, and we also have outstanding coverage of analyst recommendations. Not just what stocks have buy, hold, sell recommendations, everyone has that, but more importantly, who is making those recommendations, meaning that we actually measure the stock picking performance more than 5,000 Wall Street analysts and then rank them accordingly. Our studies show that analysts in the top 25% of their peers outperform the rest by 3 to 1. Start making a regular habit of seeing the daily updated Zen ratings and analyst recommendations on the quote pages at WallStreetZen.com. This is especially true as earnings season kicks off and the upgrades start flying. This is the vital information you need before investing in any stock. Now, I want to hear from you. How much do analyst recommendations factor into your stock selections? Do you take them as gospel or with a grain of salt? Please share your thoughts in the comment section below for the benefit of our investment community. And if you want to keep moving past the noise to locate stocks with the best catalyst right now, then I suggest you check out the video on your screen. In it, I explain a rotation that's already happening with mega cap companies and where the smart money is investing now.